Your money is secretly losing value every single day. That's right. Without you spending a dime, your cash is worth less tomorrow than it is today. This idea is called the time value of money, and understanding it explains why interest exists, why loans cost what they do, and why your savings might not be keeping up with inflation. Let's break it down. Let's say you wanted to buy this $50 chair, but instead, you lend that $50 to a friend. 2 years later, they finally pay you back. Great. Except now the same chair costs $55. That's inflation. Your money didn't grow, but prices did. So not only did you miss out on sitting comfortably 2 years ago, but now you're paying more for the same chair. Ouch. And let's be honest, there's always the risk your friend just forgets to pay you back while enjoying the beaches of Costa Rica. This, my friends, is why a dollar today beats a dollar tomorrow. This is where interest comes in. Interest is basically the price of using money. If you borrow, you pay interest. If you save, you earn interest. And it solves a big problem. Why would anyone give up using their money today unless they're rewarded with more tomorrow? But how do we figure out how much interest is fair? Economists think of it like building a tower. Each block represents a reason lenders demand extra compensation. Let's stack them one by one. First up, opportunity cost. If you give up your chance to use money today, you want a reward tomorrow. Say that reward is 2%. That's called the real interest rate. It's basically the baseline, what you need just to make lending worthwhile. But inflation complicates things. If prices rise 3% a year, that 2% return isn't enough. So lenders tack on another 3% to cover inflation. Next, default risk. What if the borrower doesn't pay back? Someone with a spotless record pays less interest. Someone sketchy? Way more. This is why your credit score matters. It literally changes how expensive it is for you to borrow money. Now let's talk liquidity. If you invest in something that's hard to sell, like a 10-year car loan, you want extra compensation. Because if you suddenly need cash, good luck finding someone excited to buy that loan. That's the liquidity premium. And finally, maturity risk. The longer you lend money, the greater the chance interest rates will rise later. If you're stuck with an old loan at 2% while new ones are paying 4%, you'll feel pretty silly. So lenders demand a little extra just for committing long term. Let's add it together. Real interest rate, 2%. Inflation, premium, 3%. Default risk premium, 4%. Liquidity premium, 2%. Maturity risk premium, 1%. Total 12% interest. That's the price of borrowing money. Every percentage point is there for a reason. Here's a fun fact. In the late 1970s and early 1980s, U.S. mortgage rates hit nearly 20%. Why? Inflation was sky high. Compared to today's lower rates, that sounds insane. But once you adjust for inflation, the story makes sense. Interest rates move with the times, literally. Now, let's get a little more technical, because the time value of money isn't just an idea, it comes with some really useful formulas. Don't worry, I'll keep it simple. Future value, compounding. Suppose you have $1,000 today, and you can invest it at an interest rate of 6% per year, compounding once per year. How much will it be worth in 4 years? Here is the formula. Here, PV equals present value, today's money, R equals interest rate per period, N equals number of periods. Plug in the numbers. So after 4 years, your $1,000 grows to about $1,262.50. That extra $262.50 is your earnings from compounding. Present value, discounting. The present value is the reverse. It tells us what a future amount is worth today. The present value formula is: imagine someone promises to pay you $1,262.50 4 years from now. What's that worth today, assuming the same 6% discount rate? Plug in the numbers. Exactly as expected, $1,262.50 in the future is equivalent to $1,000 today if you use a 6% discount rate. Now let's talk about annuity. An annuity is simply a series of equal payments made at regular intervals. Think of it like paying your Netflix subscription every month or depositing a fixed amount into your savings account every year. There are two main types of annuities. 1. Ordinary annuity. In an ordinary annuity, payments come at the end of each period, like your car loan. You use the car all month, then pay at the end. 2. Annuity Due. In an annuity due, payments come at the beginning of each period. Think rent. Your landlord always wants money up front before you enjoy the apartment. Future value of an ordinary annuity. The future value of an ordinary annuity tells us how much a stream of equal end-of-period payments will be worth in the future. The formula for future value of an ordinary annuity is: let's assume you deposit $1,000 every year into an account earning 8% interest for 5 years. Let's calculate. So, after 5 years, you'll have $5,866. Future value of an annuity due. With annuity due, payments are made at the beginning of each period, so your money has one extra period to earn interest. The formula is: now assume the same case as future value of an ordinary annuity, but you pay $1,000 at the beginning of each year instead. Let's calculate. So, in this case, after 5 years, you'll have $6,335. Notice how you earn $469 more just because you paid earlier each year. That's the power of annuity due. Present value of an ordinary annuity. The present value of an ordinary annuity is how much a series of end-of-period payments is worth today. The formula is: suppose you'll receive $1,000 per year for 5 years, and the discount rate is 8%. Let's plug in the numbers. So, the present value of those future $1,000 payments is about $3,993. Present value of an annuity due. Finally, for an annuity due, payments come at the beginning of each period, so each one is worth slightly more in today's terms. The formula is: now assume the same case as present value of ordinary annuity, but you get the $1,000 at the start of each year. Let's plug in the numbers. So, the present value of those future $1,000 payments is about $4,312. That's higher than the present value of ordinary annuity because you received the money earlier. So here's the big takeaway. Money today is more valuable than money tomorrow. Interest is the price of using money. And the formulas are the math behind it all. Whether you're saving, borrowing, or investing, understanding this helps you make smarter decisions.